What's up guys, today we're talking about Solana DeFi and we're going to focus on Kamino Finance, how to earn more yield on your Solana and other tokens like JLP or stablecoins. Solana DeFi has been heating up, so if you hold a ton of Solana and you are bullish on Solana for the next 6 to 12 months or the next 3 to 4 years, then it's a great way to earn some yield on Solana to offset the high inflation rate that Solana has. And before I dive in, my name is Richard. This is currently my yield farming portfolio. I focus mainly on yield farming concentrated liquidity pools. You can see I have a pretty good track record here, up almost $12,000 compared to holding with my positions. If you add my closed positions, I'm up roughly $43,000. This channel is mainly about yield farming and earning passive income through crypto. So this video is not really about concentrated liquidity pools, but it's about lending and borrowing. It's still a very important tool to learn as a DeFi investor. And just a quick disclaimer, none of this is financial advice. Be sure to do your own research before you invest into these protocols. So right off the bat here, if we click on this Earn tab, you can see this lending section where you could deposit your tokens into a vault and earn a nice APY. If we click Solana here, just by depositing your Solana into this vault, you can see you would be earning a roughly 8 to 9% supply APY here. And you can see like the historical APY. It fluctuates, and basically for this type of vault, what it does is there is a fund manager here. In this case, it's MEV Capital that is managing your lending positions across different markets over here. And you can see like the breakdown here to see where they're getting their APY. And what's really nice is there's zero management fee over here. So they're getting the best rate possible for you with very minimal management on your end. And there's different managers here. For example, this Alice Lab, right? They lend out your SOL in different markets. And once again, 0% management fee. And this one has a pretty high supply APY in its lifetime. But over the last 90 days, it's a little bit lower than what we were just looking at. So that's the first part. You could deposit into a vault and earn a 5 to 10% APY on your Solana and roughly 5% on your stablecoins as well. But one of the main features I like about Kamino Finance is this multiply feature. You can see here with the rewards, you could earn up to 25% APY. And on the lower end, you can see this 15% APY. So if we click onto here, what this multiply function does is it takes your MSOL, which is a liquid staking token for Solana, use it as collateral, so you're lending it out, and then you're borrowing Solana as the debt, and then looping it. Looping meaning that I'm converting more Solana into MSOL and then depositing again with the amount of Solana that I borrowed and repeating that process over time. So you could basically loop it once or do it, up to 9.5 times over here. And the more you loop, the higher the APY you're going to be able to get. So if I go to this My Position tab, if I deposit 100 MSOL, for example, you can see this APY here based on the Multiply tab. If I went for 5 loops, you can see the APY is 15%. If I go for max loop, the APY is 24%. And again, it's using this MSOL, right? If we pull up MSOL on Gecko Terminal, you can see MSOL is gaining its value against Solana. This is priced in Solana. So if you bought MSOL with your Solana roughly 1 year ago, compared to now, you would make a gain of roughly 8 point something% on your Solana, right? This is why people buy liquid staking tokens, is that you don't have to stake your Solana manually and the value accrues over time, similar to tokens like Wrap Stake ETH. So that's MSOL. And then when you loop it, you get additional return, right? Because you're borrowing Solana and then getting more MSOL, which has like an implied APY of roughly 8.3%, like what we were just looking at. So if we zoom out all the way to as much as possible, this multiply function started in April 29th. And usually the return you generate is this blue area here that is above this orange line. So if the orange line is above the blue line, you're actually making a loss, because if you look at the MSOL APY, it's lower than your Solana borrowing costs, right? When the borrowing cost is more than the yield you generate from the collateral, then you would be at a net loss. But if you believe that the supply APY would stay under 8%, then this position would be profitable over time. And the higher the multiplier, the more gains you would make, but also the more loss you would make if the borrow APY spikes really hard and stays above 8% for a very long time. So there is that main risk here. If you click on this info here, you can see you could get liquidated if the borrow interest rate is higher than the collateral token growth rate for a sustained period of time. So exactly what I was explaining, right? And there's actually no depeg risk when it comes with Kamino Finance. That's why it's really, really good. You can see that Kamino has its own oracle that uses the staking rate that the token is generating rather than the market price, meaning that you would not be liquidated. If you see this huge wick down here, normally you would be liquidated if the normal oracle that determines the price is based on the actual price. But again, Kamino Finance used the staking rate, the APY that the liquid staking protocol is able to generate rather than the market price. So it's much safer than a normal market price loop. If you're looping assets with oracles that are using market price, it could be very easily liquidated. You can see here it removes the risk of liquidation due to price depegs. If a depeg occurs, the LST positions such as multiply, for example, would not be affected. But the key risk to keep in mind that if these LST platform do suffer a smart contract exploit, these positions would still be a risk. So you have to do research on MSOL, right? In this case, it's the Marinate Stake Sol, to see if they're properly audited and if you trust them. In case their protocol gets hacked, then you would lose your assets just as if you were holding MSOL. So that's something to keep in mind. And with these vaults, you typically don't want to deposit everything in here. Like with any other investment, you have to diversify, especially because the interest rate for each vault might be different, right? If we go back here and just filter by the Sol loop, this is on the Marinate market. But if we go on to this MSOL on the main market here, you can see the APY is different from what we were just looking at. Over 1 year, you can see that the MSOL APY has been historically greater than the Sol borrow APY. And then when there's a huge difference here, that's where you can make a ton of APY with this multiply function. So really great here. And the way you do it again is, let's say you have like 100 Sol, you might put like 10 Sol here, 10 Sol there, right? And then like spread them out over these markets and make sure you're researching like MSOL, BonkSol, and the underlying assets. You want to make sure that you're using legitimate underlying assets, right? So that's the first way you guys could earn much more APY with your Solana. Very simple and straightforward. You don't have to manually loop anything. Kamino Finance does it for you in one click. And you could use lower leverage as well, right? If we go back to the MSOL main market, if I go to this My Position tab, again, if I deposit, let's say 10, and then at 1% multiply is basically 8.36%, because we're not really borrowing any Solana, right? You could crank it up. Let's say if you only want to have low leverage, it's 12% APY. So still better than just purely holding those liquid staking tokens. But again, with this multiply function, as long as the Solana borrow rate doesn't spike too hard over a very long period of time, it should be safe having higher leverage. And the next thing I want to look at is the stable loops. You could do the same exact thing like what you were doing with Solana, but now we're looping stable coins together. So if we look at Syrup USDC here, you can see the underlying APY, which is really important, right? So this is pretty new. And basically what we want to look at is the Syrup USDC APY, if it's going to be able to sustain above the USDG borrow rate. And you guys could close out of these positions at any time. Let's say the borrow rate just doesn't come down below this blue line. You could exit this vault and deposit into other vaults. Syrup USDC is similar to MSOL, where the yield automatically compounds into the token. And if we're looping this, then you could generate a roughly 21% APY. And this is with incentives. So without the incentives, maybe the APY would drop to 14%. Again, a little bit more interest rate risk. If this underlying assets spike up in interest rate, then you would be making less APY or be at a loss even. So do keep that in mind. And again, we want to research the underlying assets, make sure that it's something safe, and you also want to diversify your portfolio. And the last thing I want to look at is this JLP loop. It works the same way. You're depositing JLP and then you're borrowing these underlying assets. And as long as the JLP APY is greater than the borrowed assets, then you would be making money. But with this, you got to be a little bit more careful and use less leverage, because if we pull up the JLP price, it actually fluctuates. It's actually not stable, right? So what exactly is JLP? If we go to Jupiter Perps, it's a perps trading platform that you could trade stuff like Solana, Ethereum, and wrap Bitcoin on chain. And we click on this earn tab here, you would see this JLP pool. So this pool is made up of these assets, right? Solana, Ethereum, wrap Bitcoin, USDC, USDT. These assets are what the traders use to basically trade with. If those traders make a profit, then the assets will be paid out using this pool. And then if those traders make a loss, then those assets would come into this pool. So that's the first thing to consider. And the other thing to think about is that these are the underlying assets. Ethereum and Bitcoin only comes up to roughly 21% of the pool. Almost half of it is in Solana and 31% of it is in USDC. So JLP price fluctuates with Solana price the most because it's the main underlying asset. But at the same time, because it has a 31% allocation to USDC, it's much less volatile than Solana. If we look at the huge drawdown that we saw on Solana in the last few months compared to JLP, JLP had a roughly 36% drawdown, right? Compared to Solana, if we measure from the high to low in the same time period here, you can see the drawdown is roughly 67%. So much more stable because again, you have these other assets as well as stable coins, and also you get 75% of the fees that is generated from this perps platform. It's used directly to buy into this JLP token. And that's the APY here. This is purely based on the trading fee. It's not based on the trader profit and loss. And if you assume that traders either break even on average or make a net loss on average, then you will see additional profits, right? But that's the minimum amount that you could expect. And if we pull up Dune Analytics here for Jupiter Perps, you can scroll down and see the fees. The weekly fees has been growing over time, so that's really nice to see. So JLP is a pretty good investment in my opinion. You earn roughly 16% APY, and then you also get some asset appreciation. But like investing into any crypto token, the best time to invest is when the prices are low, right? If JLP is trading all the way at $3.37, for example, and I want to earn some nice yield, then I could basically invest into JLP with my stable coins. And let's hop back to the multiply function. So now that you know what the JLP token is, we could look at this JLP loop here. So let's click on one of them, for example, this USDT one. Sometimes the data doesn't load, but that's okay. We can look at our yield by going to this My Position tab. Let's say you want to do 1000 JLP. You multiply that by, let's say, 2.5. Then your net APY would be 28.55%. Again, this doesn't really account for like the price fluctuation of JLP. And if you connect your wallet, you could see exactly where you would be liquidated. You could deposit with JLP or USDT. Let's say I deposit 1000 USDT, right? I have exposure to this amount of JLP, roughly 3K. If my leverage is at this amount, let's say it's 3x leverage, right? Then my liquidation price is at 3.6. So 3.6, if we look back at our chart, you could definitely get liquidated, right? If the market condition is really bad. So that's a higher risk leverage. But if we dial that down to, let's say, like 1.5, then my liquidation price is much lower. I would be generating 20% APY on my capital. And if I believe that Solana's price is going to appreciate over time, then JLP's price would most likely appreciate over time as well. And if I bump that leverage up to 2, again, you can see the liquidation price. 2x leverage on this is probably still safe, and you could bump it basically up to 24% APY. So it depends on if you want to worry about liquidation or not. If you don't, use like 1.5 or just no leverage, right? Just buy JLP and hold if you think that's a solid asset. And again, if JLP's price appreciate over time, you're making those gains on top of this 20% APY. So that's really nice, especially if you buy JLP or deposit into this vault when the prices are really low. And since this data doesn't load, we don't have to worry about this. We could go to this market section. And if we just Control F and then type JLP, it will pop down to this JLP market here. So once I have this, I could take a look at the supply APY of the underlying assets, right? The JLP multiply function has exposure to all of these tokens. For example, this PYUSD, I could go in and take a look. Over the last 30 days, supply APY has been fluctuating here, but the 30 days average is only 4.45%. 90-day is only 4.69%, but a longer time horizon is 7.1%. Zoom out over 1 year here. Back here, the supply APY was much greater. Let's compare that to USDC, for example, over 1 year. So slightly lower supply APY, and over the last 180 days, it's lower as well. And let's look at USDT over 1 year, even lower than the USDC and the PYUSD we looked at, right? Lastly, the USDG over 1 year, also relatively low. So the strategy might be, let's say you have $10,000. Since the USDT and USDG interest rate is lower on the longer time horizon, then I could go heavier on those two vaults, maybe 70 to 80% of my capital there, and the rest in the PYUSD and the USDC market. So with this vault, you still want to diversify once again to prevent like a spike of interest rate in one of these tokens that could potentially put you at a loss, right? And if you guys just want to lend out your tokens, you could go to this market tab and look at all of these assets, right? For example, you could earn 7% on your USDG, USDS. It even supports Eurocoin here, and you could borrow assets as well, right? If you want to long Solana, for example, you could deposit Solana, earn a nice APY, and then borrow some other tokens like Eurocoin and USDG, which comes with like some rewards to offset the borrow APY. And you could basically get paid to long Solana rather than paying a funding fee in a perps trading platform.